Hi guys, Michael here. Today another video about the most common mistakes that beginners should avoid, and this will be a slightly different approach because as you know, trading is hard a piece of bread. Anyone who has already spent some time working on charts, regardless of whether they have achieved success or failed, will certainly say it. Trading on financial markets requires a lot of knowledge, a lot of sacrifices, and a lot of time. Regular profits, in turn, require tremendous experience. Many investors will certainly not be able to cope with that task. So this can be called natural selection, we can say. And there is no exaggeration in that. Trading is not for everyone. And anyone who is not suitable for trading will quickly learn it. Some give up after the first defeat, others try again. And many of beginners do not manage to go on track until after some time. It is definitely a sport for the persistent one. So it will not be easy, but this is very good that you are here. Watching this video will certainly help you avoid many fundamental mistakes, making your first steps in the world of trading much more enjoyable, we can say, calmer and more effective for you. So it's important not to go on shortcut. Taking the easy way always ends badly. For this reason, you have to do everything sequentially. There is no other way to profit in the Forex market. The shortcut will lead you only to painful losses. But don't worry, the market will reward you for your patience and hard work. So let's talk about the problems you'll come across and how you could solve them. So the first common thing is not knowing the basics, i.e. throwing yourself into deep water. One would like to write that the basics are the basics. However pointless it sounds, these are the facts. You can't build a house without foundations. Or, well, maybe it is possible, but it will not stay for too long, right? That is why it is so important to start with the solid foundations. So thanks to this, we will gain an advantage over others at the very beginning. Before we start our adventure with trading, we need to familiarize ourselves with the most important issues related to technical analysis, fundamental analysis, including above all macroeconomics and indicators, operations and support of trading platforms, investment psychology and risk management. Only with the knowledge of all these issues we can start thinking about trading. Knowing the fundamental issues of trading, you can make your first attempt to build a profitable trading system. However, it will be an even more demanding task. Creation well-functioning, practical and effective system for trading on financial markets, be it Forex or derivatives, whatever, is a very time-consuming and labor-intensive activity. It's worth it though, of course, but the passage through the maze of technical analysis indicators, dozens of indicators and hundreds of strategies proposed on the web will be rewarded with real profits. However, of course, before we start trading on the real market, our strategy must be thoroughly tested both in current market conditions and by backtesting, i.e. automated tests on historical data, which are possible on many trading platforms offered for free by the Forex brokers. So we can start using such a tested profitable strategy in trading real money on financial markets. So second thing is hooray optimism after profitable positions. The so-called hooray optimism that initial traders feel after the first trades close with a profit is one of the biggest enemies of profit-making trading. At the moment when we are novices, it seems like everything works out for us. It also seems to us that we are better and smarter than the market. It happens notoriously when the traders deviate from the initial assumptions and, as a consequence, start to lose. Then there is a panic and stress and the desire to pay back, of course, right? Which in turn leads to gambling and the loss of not only previously earned money, but also invested funds. An old market proverb says you can't shoot everything that moves, right? A profitable strategy is not enough. A mental resilience is also important. Resilience to both success and failures. Both have a bad influence on novices investors and tarnish them with emotions. Unfortunately, this leads to an inevitable defeat. Of course, you can enjoy the fact that what we do well, and it brings us tangible benefits. Remember, however, that we are not smarter than the market. Perhaps at the beginning we experience the so-called novice luck. However, this state of affairs will not last forever. So, next thing is no consistency in implementing the strategy. So the mentioned hooray optimism leads to inconsistencies in the implementation of the assumed strategy. The first failures also leads to the same. However, it was not for this that we spent tens or even hundreds of hours on a demo account testing indicators and strategies, so as not to use them after switching to a real account. It's absurdly illogical and pointless. If our strategy is profitable, we absolutely should not abandon it. It often seems to us, when of course our strategy works perfectly, that if we improve something in it, we will certainly start earning more. Unfortunately, greed is not good in this case. Usually, such fixes will break our system and we will start losing money faster than we are earning it. Therefore, such behavior should be avoided completely. On the other hand, you also need to keep your nerves in check when you suffer losses. If our investment strategy has been showing satisfactory results on a demo account, there is a good chance that it will be similar on a real account. A few failed transactions do not yet mean that the system is not functioning properly. Perhaps the losses are due to the fact that due to the stress that accompanies traders, in which we risk our hard-earned money, we have changed something in our system. If, on the other hand, this strategy has actually stopped working, let's not change it too quickly by trading in the real market, and let's step back and start retesting it. So another issue is overtrading. It is another threat waiting for novice traders. And what is it characterized by? Basically, when you trade too much. This is due to choking on the market, and it is something that repeats itself notoriously. The phenomenon of overtrading occurs both when we post more profits because we want to earn more, and when we suffer losses because we want to win back as soon as possible. Unfortunately, searching for transactions by force leads to bending of the previous established and tested strategy, which in turn brings losses, of course. It is not worth trading by force. It is better to miss an opportunity than to keep looking for it. If we don't open a position, no catastrophe will happen. It is also not worth catching the opportunities that we have already elapsed. Another thing is failure to apply the principles of money and risk management, and this is like a mantra in almost every video, the risk management. Any investor with experience will say that without money management and risk management, i.e. capital and risk management, no strategy will function well. A strategy that does not take the sense 2 points into account is not even a strategy. At the very beginning, before we even start trading, we need to determine how much we can transfer to the investment account and how much we are willing to lose. In addition, we need to determine the amount of loss that we can afford in a single trade and when we will close all profitable trades. So by definition, it is assumed that in one transaction you should not risk more than 1 to 3% of the total capital employed. The most common strategies have a risk of around 2% and not a penny more. You absolutely must not bend the established rules of risk management. For this purpose, we set a stop-loss order, i.e. an order that will automatically close a losing position after reaching the set limit. This is like an obvious thing for everybody. In addition, it is good practice to also place a take-profit order, i.e. an order that closes a profitable trade at a distance twice the trade opening level as a stop-loss order, something like this. So thanks to those orders, we will earn twice as much on profitable transactions as on lousy ones. And in addition, we will prevent ourselves from taking positions that are too large in relation to the value of our investment account. So now let me summarize all the principles more or less. These few issues described are the foundations of moving around the financial markets, with particular emphasis on the non-forgiving currency market. It is very important not to make stupid mistakes. Many of the most common novice investors or novice traders stumbles are easily avoided. However, this requires a lot of patience. At the beginning, you have to study hard because without solid foundations, no one can stay on the market for too long. Later, there is time-consuming work with backtesting and paper trading on which we have to build a regularly profitable investment strategy. It must contain precise details describing the moment of opening and closing the transactions, as well as the rules of risk and capital management. So, prepared in this way, we can start trading in the largest market in the world. So guys, that will be all. Remember to check LiteFinance on other social media like Instagram and TikTok. And if you like this video, then just subscribe for more. Thank you. Goodbye.